Jean. Next question here. How do you hedge your portfolio of stock with an indexed long put proportionately? Okay. Here, I'm going to send you the link directly. We covered this a couple weeks ago. It's almost 5:30 now, but rather than walk through it step by step, Gene, we're going to talk about a couple of things, but I want to take you right now to our blog. So blog.poweropt.com, okay? And I'm going to enter a simple search text here. And my search text is going to be stock or portfolio insurance. Okay. Part 1, stock or portfolio insurance. This is for the stock traders. Part 1 is a series of evaluating ways to add portfolio insurance for anticipating market corrections. And it does go through the idea of buying shares of an inverse ETF. Okay. I just wanted to show here. So common ways stock traders, since you talk about protection when, set a stop, sell out now, stay in cash, of course, obviously. Buy shares of the inverse ETF, which may cost a fair amount of money to protect the portion that you want. Okay, buying just the shares exactly. Or shares of the leveraged ETFs as well. Now, I know I'm going a roundabout way, but part 2, this is the one I'm going to send everyone the link to in a moment. Part 2 of stock portfolio insurance is actually a video, and it kind of answers your question right here in the first slide. How can I protect my portfolio against a minus X decline? Clarifying the point was, how much of the decline do you want to protect? So if you're expecting a 10% decrease on the broad-based indexes, and you want to hedge against 50% of that, so your portfolio shows a 5% loss, this webinar walks through, and we have the description here too, but this webinar walks through the calculations that you would use to hedge your portfolio based on how much you wanted to protect using put options on the index, and also with using other ideas as well, VIX calls, in addition as a secondary thought for the management techniques also. Okay, so I'm going to send that link to everyone. That's where I want you to go. One of the keys here is doing the math yourself a little bit. There is an equation that's shown in the webinar, I believe, that I used to determine the actions, but just as we did before, let's say I've got $80,000 invested in stocks, in a portfolio, in a bullish portfolio, Jane, that could be affected by a 10 to 12% decrease in SPY. Of course it would be affected, right? If I've got $80,000 portfolio, relatively in bullish positions with about a 1 beta to the SPY, a 10% decrease would be what? It'll be a loss of $8,000. Okay, so now, as we did before, oh, and by the way, what would a 10% decrease be on SPY? We know we're at 282. I'm sorry, Gene. We're at 282. So a 10% increase would be $28, which would take us pretty much down below to that 250. Oh, sorry, that's a 20. No, that's right. That's a 10% increase. I'm sorry. So the $28 drop would take us down to about 254. Okay, SPY, 254. That'd be that 10% decrease, which would be $8,000 against me, wouldn't it? Now, I know I'm going to have to invest more to hedge that, but let's start off with just $2,000. And let's keep that same time frame. Well, it's a bit extreme, but let's say May 22nd again. Okay? This, again, is not a recommendation or suggestion. I'm not projecting that SPY is going to fall 10%. Well, why am I using that? It's going to take a minute to calculate. I do apologize for that. But why am I using this tool? Remember we looked at it earlier for Eileen. And what we saw was that if we bought one contract of that $292 strike for $14, and SPY fell to 260, we'd have a gain of $18 as the option would be worth about $32 of intrinsic value. Okay, so what did I just show? Well, I just showed that $1,800 would be the gain. You have an $80,000 portfolio. You're expecting a 10% decrease, which would potentially draw down your portfolio by $8,000. How many contracts now would you need to buy to turn that $1,800 gain, if the projection turns out to be true, to be $8,000. When we're talking about 5 contracts there, yeah, you'd need 5 contracts at that $14.70 price. And that's simply what the equation says. Using the long option finder to figure out which option would give you the best bang for the buck. Here we're at the 287 put, currently at around $1,200. And if the stock, I keep saying the stock, I apologize, guys. If SPY fell to 254, that 10% oh, I'm sorry, it's at 286. I'm sorry, it wouldn't be 254. It would be closer to 260. Well, let's say it falls to 254, 255. For one contract, we pay $12.64, and it'd be worth $33, which is what? That's a roughly close to a $21. It's a little bit less, isn't it? It's $20.34. $2,034 for one contract. How many contracts would you need to hedge the 8,000? 4, right? So you know that would cost you $4,800 to cover about half of the loss of 8,000. You'd have a profit of, again, about 40, I'm sorry, it's about 20 here. So you'd have a value, a market value of 8,000 to counter the loss on the portfolio in that case. That's how it is. That's how I use this tool, and that's what we talk about in that webinar to the link I just sent you guys. Stock or portfolio insurance part 2. It's in the chat window. For those of you who watch this webinar on the archive, just go to blog.powerup.com as we showed and put in the search there, stock or portfolio. You can even just put stock or and hit search. It'll come right up here, and you can see the link up here, blog.powerup.com 2017-09 /29 part -2 stock portfolio insurance /. Okay, but it's easier just to go to blog.powerup.com, run that simple search, and you're there. That's how I do it. That's how I run the equation, is figure out if the indexes fell X or Y, what would that affect on my portfolio? Then, using that tool, the insurance tool, I can see which put, just by one contract, maybe as we did before with Eileen, put in 2,000, put in 2,500, so you can get some of the better puts that are even overpriced right now. If the indexes drop that 10% on the target date that you fear, what is your monetary gain? Okay, so this is your estimated value. I'm subtracting it here, the 3,300 minus the 1,264, that was 2,036. But I know my $80,000 portfolio, if there's a 10% drop, would lose about 8,000. How many contracts would I need if I'm gaining 2036 to cover the 8,000? Be 4 contracts. I'd be putting up about $5,000 there to cover that loss. Okay? But it does go through it a little bit more in the webinar with the descriptions and I don't want to say charts again, but sort of comparison graphs of if there was a 10% drop at the time we looked at it in 2017, what would X amount of contracts of SPY cost and how would it protect versus X amount of contracts of SPX versus buying the shares, SH, the inverse SPY, and more. Okay. Dan, it's a great question. I did mention this earlier in the webinar, I think, but I probably wasn't clear about it. Dan says, would you then put a stop in at 50% loss for the insurance so you don't lose it all? Not necessarily a stop, Dan, where I would close it out, but yes, I had mentioned that even when using insurance, I don't want to take a 50% loss. So if the market starts going the other direction, hopefully it's going a better direction that's giving me that, beta 1 bullish position we talked about of $80,000 to cover the cost. But you're 100% correct. With my VIX calls, unless it's a sudden movement that I can't help it, but when I use VIX calls for the hedge protection, I usually buy 7 or 8 contracts at $1 price. And as I mentioned, I was doing that when the VIX around 13 or 14. I was usually looking at the 16 or 17 strike, 30 days out, 40 days out, which was a $1 premium. If that dropped to 50 cents value, I wouldn't just close it and not have the insurance. I might roll it. As we talked about before, I might sell to close it, take the 50-cent loss on that one, and then maybe roll out to another 15 or 20 days. So I'm still covered for the next 30 days for the unexpected with a new price. Okay, and that's what I typically do. But if I'm concerned, and in Jean's comment there, if you're concerned about buying portfolio insurance and it doesn't start to go the direction that you want, Yes, I think it's a good idea to have a 50% stop, but I don't think it's a good idea just to close it, Dan, and say, oh, I took my 50% loss, I'm done, the rest of my portfolio is good. I would likely roll it in that case as well. And Dan, I know it's tough to lose 5,000 to protect 8,000, but again, that's the math. And another key on this, Dan, and I agree with you, but another thing that's shown in that webinar is I had talked, I wish I had the slides here. I don't think I have the slides on this computer where I could pull it up real quick. I have it on the other computer at the office. But we were talking about a portfolio of $80,000. And we're saying we're close to a beta of 1. Now this means $80,000 invested into bullish strategies that we want to hedge if there's a 10% decrease. Well, let's assume a near 1 beta, Dan. And again, so we'd expect this to drop 8,000. So that would be our loss. Okay, a 10% loss here would be that loss of 8,000. Now, I just walked Gene through, this would be a value of 2064, and to get the full 8,000 back, we would be buying 4 contracts. 4 contracts at 1264 would be close to $5,000. And I agree with you, Dan. That's tough. It's tough to give up $5,000 if we only see a 2% movement upwards over this time. So my portfolio here only moves up 1,600, right? That's a gamble. But something else is mentioned in that presentation. The 10% drop would lose 8,000. Am I really going to try to hedge the entire 10% drop? No. More than likely, what you're setting up for yourself when you look at your numbers in your portfolio is saying, if there was a 10% decline, I would lose 8,000. What do I need to hedge half of that loss? You're not going to try to cover the full loss. Otherwise, you would just open a bearish portfolio. Am I right? So we know that losses are going to happen, but the idea is to hedge some of it, not all of it. So now I'm only putting up 2,400, 2,500 to protect a drop of 4,000. And what's great about that, if the decline is steeper, if it's a 12 or 15 or 20%, this still increases. This is still being covered for lower cost. Of course, I should have mentioned that before, Dan, but you're absolutely right. To answer Gene's question, I showed him the mathematics that was used if you wanted to cover the whole. But in general, an investor won't try to cover the full expected 10% loss on the position. They're trying to hedge half of what they could lose. They only want to lose 5% if there's a 10% decline. They only want to lose 7% if there's a 15% decline. Okay, I'm sorry. Let's be honest. Every investor online and every investor out there wants to lose 0% if there's a 12% decline or 0% if there's a 10% decline. But as you mentioned, Dan, to complete hedge a portfolio to cover the full loss of that 8,000 on a 10% decrease might not be mathematically reasonable for your portfolio long term. Okay? All right. Yeah, so if you're bearish, if you're totally bearish and you're trying to hedge completely, yeah, you might just want to buy puts on SPY as it is for the profit. Jean says then it might be some married calls. No, I won't use married calls. What I would, because I don't want to short the position. I don't want to short the ETF. The reason why I don't do married calls, the opposite of the married puts personally. So what do I do in a married call? I short an underlying that I feel is going to decline, of course, because this is bearish, and I buy a call option to protect the loss if I'm wrong. What I would prefer to do, rather than this, which involves shorting an ETF or shorting a security of any kind, which is going to come with a monthly or sometimes even bi-monthly margin cost to my broker because I'm borrowing the shares, which is going to increase this maximum risk every time I make a payment. Of course, you never do this on a dividend-paying stock because you have to pay the dividend. So rather than do that, I'd be more apt to open a married put on an inverse or contra ETF, which Sam has brought up many times before, that one of his hedges he prefers to use is UVXY, buying shares of the volatility ETF outright. So if there's a fluctuation and it goes up, well, his portfolio bullish positions might be going down, which he might be out of anyway, but UVXY is gaining because volatility is increasing. I mentioned that I like to use the VIX calls as a market hedge. Well, that's when it was at a realistic price. I did take advantage of those and take profits of those to cover losses and profit more in the first run towards the end of February. But I haven't bought any new ones since then. Why? Because when the VIX was hitting 85 and 90, I could go to 120 strike 30 days out, 120, 33% out of the money, and this was still $28. That's not a fair price. It'd be better to buy the ETF at that time because you're not fighting time value, and as a joke, the volatility of the volatility, which made those hedges too expensive. But buying shares of a $34, and I'm not talking about buying 100 shares or 200 shares, when EVXY hits 40, 42, 43, it's still okay to buy a couple shares, 10 shares, right? You're not paying that much money to do that. It's still a reasonable price to have a hedge in your portfolio if it continues to move up. But contra ETFs and so forth, Gene, so I don't have to think backwards. The inverse SH, the inverse SPY. If I think it's going to fall, if I buy shares of SH or I do a married put or the 2 times SPY ETF, as the markets fall, those go up. I'm not borrowing shares and paying an extra margin fee by shorting the stock. I'm using an inverse ETF as a bullish play to hedge the decline on maybe the other longer-term positions, longer-term bullish positions in my portfolio. Ladies and gentlemen, it is 5:45 p.m. Eastern Time. I do not see any other comments that have come in that we haven't handled, but of course, if anyone has a last-minute comment, I'll be more than, or last-minute question, last-minute comment, of course, I'll be more than happy to go through that with you as well, if you have any last-minute thoughts on that. But in case we don't have any, might as well go ahead and start our wrap-up for today. I just want to remind everyone that today's material are my thoughts on your questions, designed for educational purposes, increasing investing performance and knowledge of options investing. Any stocks or options discussed today should not be taken as direct trading suggestions. I'm not saying that SPY is going to fall to 260 in the next 30 days. I'm not saying it's going to fall to 254. We use that tool as an example to show Eileen which put might be the best one to roll to based on her expectations, and to assist with Jean's question, about what put you might want to buy to help hedge your portfolio if there's a decline of X or Y. First, figure out how much would that affect your portfolio, and then how much of that loss do you want to hedge, and then using SPX, SPY, hey, you could use QQQ if you're more heavy into tech stocks, or even NDX, and see which put to buy would give you the best one. But I'm not saying those are going to happen. I'm not saying those are my expectations for the market going forward. Okay? All right. Options do involve risk, as we've seen, may not be suitable for all investors. That's why it's always important to trade with protection and proper position sizing. Now, those tools that I mentioned, the insurance tool to try to lock in a gain if you have an underlying price that we talked about for Graham. We did look a little bit at, mainly, of course, was that long option finder for helping not only find speculative calls or puts to buy based on your expectation, but also, of course, how to help you with which puts you might want to buy on an ETF or index to hedge your portfolio based on an expected decline going forward and how much you want to hedge against it. The only way to get those tools, if you're not there already, is to take a trial to Power Options. Simply just go to powerop.com, put in your name and email address. No billing information is required. Just click Start My Trial. We'll send you a password. You'll have full use of the site for 14 days with no risk of being billed or credit card implications as well. After that, the subscription levels start at $45 per month for end-of-day data, only $65 to access all the patented search tools for the various strategies, portfolio tools to track and manage your positions, those signature tools for stock insurance, portfolio insurance, long option finder, and much more with 20-minute delay. That's only $65 per month. We do offer real-time service as well. Now, other free education, as mentioned, you can go to that webinars page at any time, powerop.com/webinars.asp. We talked about the 8 ways to manage the bull put credit spread. It's listed right there in the option strategy section. There's also other webinars available there for managing long calls and long puts. Even if for part of insurance, those rules as we just talked about with Dan still apply. You can always check out many of our archives from our Friday sessions from years past on our YouTube channel. But if you have a thought of something you want to research, say bull put credit spreads, you can go to our YouTube channel. Just look up Power Options on YouTube. While you're on the channel, just do a search for bull put credit, bear call credit, and it will pull up all the webinars over the years that we've taught on that subject. You'll be able to scroll through very quickly to see which one best applies to your needs. And of course, go to the blog, blog.powerup.com. For right now, the main ones there that are really beneficial, plug in that search for stock or portfolio insurance, or just stock or portfolio. You'll see those two webinars there. I'm sorry, there's two articles, one article and then another summary article with an embedded video that talks about the math and the comparisons a little bit of the different types of stock or portfolio insurance that are available. That is going to be expanded in the near future and probably be a small cost product available where we're going to cover in depth all of the details of protecting stock directly, protecting a portfolio, and the 5 or 6 different means and comparisons of protecting a portfolio with the tools that we have at our disposal as options investors. All right. All right, ladies and gentlemen, thank you again for your time. Take care. Have a fantastic weekend. Stay safe. Stay healthy. You have questions at any time, give me an email to support@powerup.com. And remember, you can also call us during market hours at 302-992-7971. Trial members and subscribers can always schedule one of those coaching sessions.